Hey, welcome back. Thank you so much for joining me. This is Mr. Market, and we're now into episode 32. So today we're going to talk about the market and why I'm leaning bullish for the last 3 months of the year. Then we'll go over our trading performance for the past week, and that'll be it. This is going to be a pretty quick episode. So in our episode last week, we talked about how the market was setting up for a rebound, and that's what we started to get. The market had a pretty rough week, and it dropped all the way down to the $420 level. But coincidentally, that is also where the 200-day moving average was. And a lot of traders and investors look at that as a point to go buy on a dip, and that's what we got. Interestingly, that uptrend that started way back in October actually broke. And so it was a really critical point to see if that $420 level would hold. And it did. And as soon as traders got enough confirmation that it stopped falling, they did the natural thing, which was to buy. And when you have an oversold condition and you have a new buy signal that triggers, usually the buying tends to be pretty strong. And today was a good demonstration of that. Even though we had that negative surprise with the conflict out in Israel, the momentum indicators and the accumulation had become so positive that typically when these momentum tides turn, the dips tend to get bought, and we have continued to see that. So even though we had this negative news, the fact that it's holding up is a pretty positive sign. And speaking of positive signs, we can see here that the pendulum algo went positive for the first time on Friday, October 6th. It actually turned positive early in the morning, and so I adjusted my positions and got pretty heavily long. I'm now currently about 4x the market with strike prices at 420, 419, and 418. I originally had some positions at 410 from last week, but I rolled those up higher today as the market continued to act well. So why did the market bounce? I think part of it had to do with just the exhaustion of the selling. Here's an interesting chart. I know it looks like a bunch of gibberish here, but it's really interesting because it tracks the percentage of stocks in the S&P 500 and compares it to its 50-day moving average. And when over 90% of the S&P 500 constituents falls below its 50-day moving average, historically it has shown a very good buy signal. If you take a look at this chart, every single time you see that little circle, those are the areas where the market has fallen to these oversold levels, and we are in one right now. Which leads us nicely to the most important part of this episode. So there was some research released just about a week ago that showed that if the S&P 500 is up at least 10% through July, but down in August and September, the fourth quarter has never been a down quarter. And in fact, this buy signal has been so strong that on average, it has returned 9.46% the last 9 times this happened. It has never fallen once. And so if history is any guide here, then we have a potentially good-looking fourth quarter up ahead, which ties in really nicely to the historical performance that we've seen going back to 1950s for the fourth quarter. With that said, let's take a look at our performance. So for year to date, we are up 18.47%, while the S&P 500 is up 13.58%. And since we started trading on the pendulum algo signals back in July 1st of 2022, we are up 37.55%, while the S&P 500 is up 16.15%. So we're doing really well. We are returning a little bit more than 2 times the market. And typically, you can see that we do better than the market during the down periods. The nice thing about our strategy is that we have a lot of downside protection, and so we don't participate as much on the dips. But when the markets do rise, we participate about half on the way up, but on the way down, we typically hold our ground and on average actually make a little bit of money. And it's this dynamic over the longer term that has allowed us to outperform the market. I also want to make it clear that this performance is based purely on an option selling strategy. We are not buying stocks. We are just primarily selling puts and calls on the S&P 500, and occasionally we will do some earnings plays and do the IV crush, the implied volatility crush on earnings. But given my unfortunate experience with NVIDIA, back in May, I am leaning more towards just focusing on the S&P 500 and keeping this a pure strategy that just trades the S&P 500. In fact, if I had to guess, that Nvidia probably wiped out all the little individual earnings plays. So the net number that you're seeing here is what's left over from just purely trading the S&P 500. So that's all I've got for today. Thank you so much for joining me. And if you haven't yet, please click like and subscribe so then you'll know when my next videos drop. You can also find me on the web at mistermarket.us or mistermarket.us. Also, you can send me an email at mistermarket247@gmail.com. Thanks again for joining me, and I will see you next time.